Locking your interest rate is one of the most important steps when it comes to the mortgage process. So what questions should you be asking yourself? Which questions should you be asking your lender? In today's episode, we're diving in to the idea of locking your rate and what's important in that process. Josh, you talk to a lot of people.
We do talk to a lot of people. And before we jump into the 5 questions that you need to ask to make sure you're doing the right thing with the rate lock, let's step back. The number one thing we get on inquiries from the show, you have a line item in there. What's important to you about shopping for a mortgage or getting connected with a lender? I want to get the lowest rate. So people want to get the lowest rate, but part of what we're going to talk through here is this lock process is going to go a long ways towards dictating that. We talk about you need to shop with all lenders on the same day so you know where they're at. But you would not be shocked, Jeb, to hear some of the crazy things that I hear idiot loan officers tell borrowers about why they should wait until the 18th because the Fed's going to meet, or we're going to get a blue moon and that generally coincides with much lower rates. Let's leave it floating. Probably the worst example I have as a listener to the show that we reached out to us when rates were near their lows last fall, but coming off of that the guy could have locked them in at 6.125. The loan was in, approved, and sitting there, and told them the rates were going lower. Don't lock it. And when the guy finally reached out to me, rates were 0.5% higher on a $750,000 loan. So the rate that you're getting a lender that has very competitive rates is good, but getting someone that you can trust to advise you on this, to walk you through these questions, to make sure none of us have a crystal ball. You are not going to time that perfectly, but there are some best practices, some questions that you need to answer to make sure we're on the right side of it.
And so with that, Josh, you like to start with risk tolerance. Explain what that means. So if somebody comes into the process, they're ready, they're talking to you, they've decided, more or less that they're ready to move forward with you. How does that coincide with moving forward and the questions that you're asking?
Well, let's think in terms of when I usually have this question is most transactions in the current market, 65, 75% of transactions are purchases. So cool. We know what loan program you're on. You're out shopping. We're giving you pre-approval letters. You get a property under contract. Now the contract comes over. Immediately, we're going to have that discussion. Do you want to lock the rate or do you want to float it now that we have a property? So on a refinance, we may have said, hey, we're going to move forward. And we have to say, okay, cool. Do you want to lock or float that rate?
Well, explain what lock and float means, because, we're talking to first-time home buyers. A lot of people don't understand the terminology. Locking a rate is what versus floating a rate?
It's getting a commitment from the lender that if you close within this time frame, so locks can be for different time frames, but if you close within this time frame, they're going to give you this rate at these terms. Terms meaning you either paying some points, getting a credit, paying 0 points. So it's taking that rate price element out of the equation as long as you close that transaction in that timeline.
Good. And the second question, Josh, before we go back into the tolerance thing that I probably should have brought up earlier is locking a rate. When can you do it in the process? Can you do it in your initial conversation, or do you need to wait until the property's under contract? Because I think a lot of people, they hear a rate, they're like, yeah, that's a good rate. I'm ready to take that. And things change.
So there are lock and shop programs, but kind of what you're going to see in this conversation of what questions you need to ask. If you have a property, once you find it, it's likely going to take 21 to 30 days to close it. And it can take months to find a property if you're in a tight market. So from that perspective, the lock and shops are usually for 60 days. They're usually not the best price lenders. There's a cost to the lender to hedge that. There's not an actual window that they go to and say, hey, we're locking this interest rate. They have a capital markets desk where they hedge their entire portfolio of loans that is open and in process for closing at a certain time. So there's a cost to them to that. And they price it every day so that they can hit their margins. So from that perspective, the lock and shop, unless we're in a market like we were in 2022, where from like February through the end of the year, it was a straight march up. Unless you're in that kind of a market, the lock and shop doesn't really make sense. So on a refinance, once you select the lender and say, hey, I want to get a refinance from you, you can lock it immediately. On a purchase, generally it's once we have a contract, because your loan is locked to you, which is basically your social security number, and to the property, which is an address.
All right. So with that said, going back to tolerance, what does tolerance mean when you're talking to a borrower and they want to lock or shop or float or whatever the terminology is?
So in super simple terms, let's go back to that example. Jeb, you send me over a contract for a borrower we're working with. I call them and say, hey, congratulations. You got 123 Main Street under contract for $500,000. One of the things we need to decide is, are we going to lock the rate or are we going to float it? And they go, I don't know. What should I do? See, first question I ask, and the first question you must ask yourself is, what is my risk tolerance level? A million different ways we can look at this. If you're a traveler and you go to Las Vegas, do you get off the plane and start putting dollars in slots at the airport and can't wait to get to the blackjack table? Or are you there to see shows, hang out at the pool, go shopping, that type of stuff? Most people are not highly risk tolerant. I would say 1 to 2 out of 10 borrowers will say, well, I'm kind of a gambler. Well, I'd like to roll the dice. So that doesn't mean that that person that wants to roll the dice should float. It means that's the person who it may be appropriate for. I'm going to say 50% of people go, oh, I hate risk. I don't like that at all. And unless we feel like the market is in a really strong downtrend, for those people, we're going to say, hey, we're supposed to close in 28 days. Let's just lock this loan and take the stress of daily rate fluctuations out of this equation. You're going to be worried about home inspections, appraisals, getting your loan approval. Let's just remove that piece of stress from the situation.
Yeah, and if when you talk about the people that are the more of the gambler type, that's me, Josh. Refinancing last year, I waited until the last possible minute to lock that rate, just because, again, something we're going to talk about here in a moment, the market was kind of bouncing back and forth, and I thought there was an opportunity for rates to move lower. I was a gambler. And unfortunately ended up taking a little bit higher rate than I could have once locked because I decided to push it off. So you have to understand that risk, right? Even as a gambler, there's a chance you don't win and you're going to end up having to take a higher rate, and you just have to be okay with it.
Well, what you just said is a good transition into question number 2. What is the current market environment for interest rates? Rates can only do 3 things. One is they can stay the same, just be flat throughout your process. They can go up, they can go down. So flat is fine. You were okay with the rate. You got pre-approved. You went out and found a house. So flat's not a problem. Down, not a problem. You're like, awesome. Rates dropped 0.5%. I got a better payment. The only one that is problematic is rates going up. So the problem is no one has a crystal ball. Jeb, you were putting new books on your bookshelf yesterday and pulling out going, look at how many books I have on technical analysis. So you have 20 plus years of experience in mortgage and real estate, investing, options trading, going through technical analysis. You're a gambler and you got on the wrong side of that. So it is important to know that when we're saying you need to know the market environment, nobody has a crystal ball. We don't know what happens tomorrow. Yeah. So knowing the market environment comes down to a couple things.
Well, with that, Josh, our biases get in the way, right? We want lower rates. So we see the things in the news, in certain technical analysis that essentially gives us that opportunity to lock a lower rate. That's more of what we see versus seeing the other side of it, right? And so you've got to know that about yourself. You've got to know that about what you're looking at, because ultimately it will help you make better decisions.
And also go back to the psychology piece of it, not just biases. Most people can deal with leaving a little money on the table a lot better than they can with actual dollar losses. So if you lock and rates drop 1/8 or 1/4%, I will get a comment from a borrower, oh, we're a little bummed, we should have floated it. But the borrower who doesn't lock and the rate ends up 0.5%, they lose their minds. They lose their minds. So it's some asymmetrical risk there in terms of what pain being on the wrong side of it will bring to you. So the most important thing that I would say in this, what is the current market environment? Where are you getting that information from? Who are you listening to? Again, I don't have a crystal ball. Jeb doesn't have a crystal ball, but we watch this very closely. Multiple experts, thousands of dollars a year of analysis that goes into this to give us a pretty strong idea of what direction it's going to go. We talk about Jeb in his books on technical analysis. What does technical analysis do for us? It's essentially like counting cards of blackjack. It tells us when we can bet heavier because the odds are in our favor, but it does not guarantee we're going to win that next hand. So when I say, what is the current market environment? Who are you relying on? Because again, loan officers, for the most part, have no clue yet they want to talk like they know what they're talking about and will tell you in really certain terms. Like I said, wait until the 18th, the Fed's meeting and they're going to cut. Cool. That doesn't mean mortgage rates are going down. It actually means they're more likely to increase a little bit. But that's a question there. You got to ask yourself, who am I relying on? There are online sources that you can go to yourself if you're dealing with a loan officer that you don't feel like is equipped to do that. And some loan officers that aren't equipped to that, to their credit, will just say, hey, that's not my job. I don't have a crystal ball. I can't tell you what's coming next. And they won't even give you insights into it, which is better than acting like they know when they don't.
No, and on top of that, the only thing I would add is pay attention or have a loan officer that understands what news affects interest rates or what has a bigger impact typically on mortgage rates. At the moment, a lot of things are affecting rates, right? Whereas when you look back historically, it's primarily inflation and jobs. Now you get ISM, you get different measures of things that impact inflation and different things. And they all kind of are playing into rates, maybe not so much as big as some of the other things, but they're all having an impact. So your loan officer, if you're a couple of days from needing to lock a loan and you know a jobs report's coming out tomorrow, you need to be having that conversation about how maybe if it doesn't go the right way, it could impact you in a much more negative way and not force you to do something, but just kind of push you in the right direction. Because like you said, Josh, people, looking back on it, once their loan is locked, it takes a lot of the emotion out of it. It takes a lot of the volatility out of the process. And yes, we all want the lowest rate, but at the end of the day, what we don't want is a much higher rate. So Josh, if somebody's going through that process, how long did they need to lock a rate for? Because we have people that are buying new construction. They're saying, I'm not closing till June, Josh. I know the market's going crazy right now. Should I lock now? How do you determine when you should lock, how you should lock?
Let's first talk about why it matters. So think of locks come in different terms. Some lenders do custom terms, so I can do whatever. I need 6 days, I need 19 days, I need 34 days. I can do that. Most lenders price out their rate sheet, 15-day lock, 30-day lock, 45-day lock, 60-day lock. And it's like term life insurance. If you want to buy a life insurance policy protecting you for the next 5 years, it's pretty cheap because you're not likely to die in the next 5 years. If you want to get one for 30 years, it's much, much more expensive because we have a longer period of uncertainty. So other things being equal, you want the shortest lock that will cover you through your closing. So we need to say, what is my closing date? Is this the type of transaction that may have some red flags that we might close late? New construction. New construction is notorious for getting pushed back and not being ready to close on time. If we have inspections and negotiations, things are going back and forth. We got a crazy seller, or let's say we have a tenant occupied property. It's not even the seller. We have a tenant occupied property that you're buying, and the tenant won't let you in for inspections, appraisals, and things keep getting pushed back. Could tell us we need a longer lock. For the most part, this is contractual. This is an easy question for you to answer on a purchase because you're going to say, I am supposed to close on the 15th of February. That is 36 days from now. If I want to lock today, I need a 45-day lock, unless I'm working with one of these lenders that has those custom locks down to the day where I can do a 38-day lock and get me just a day or two past closing on that. On a refinance, slightly different situation in that it really is incumbent on the lender to tell you, hey, I've looked at your loan application. This is a pretty simple file. We have an appraisal waiver. We can get this done in 15 days. Or, hey, this is complex. It's a jumbo. It needs 2 appraisals, multiple underwrites, a second signature. We're going to need 30, 45 days on this. Most loans, especially on the refinance side, are going to close within 30 days. When we're hammering away and things are going well, a lot of those loans with appraisal waivers can get done in 17 to 21 days, which can save you a little bit of money because you're able to get a shorter lock. But you need to go through that with your loan officer. And really, some of that is incumbent on the loan officer. Because if I tell you, hey, we're going to close your loan in 17 days, you want a lock, we're going to do a 17-day lock, and then we don't close for 21 days, I shouldn't be able to go back to you and say, hey, you need an extension for 4 days, which is going to cost 10 basis points because I didn't give you correct information. So whenever I tell someone, it's the number of days that I know for a fact we are going to close this loan, not what is the best case scenario for when we can close the loan.
Yeah, and if you're somebody out there that's in the process, considering getting a loan, looking around, whatever, better than having to ask yourself these questions, find a mortgage professional that's going to essentially ask these questions of you and tell you the process without you having to actually ask them. And the reason I say that is because there's a lot of professionals out there in the industry like our team, and then there are people out there that just do this part-time or only been doing it a short period of time. So if you want to work with professionals, want to work with our team, that link in the description will get you in touch with us. So Josh, this is probably the bigger question that's happened. Actually, the last two are probably the biggest two questions over the last couple of years that we're getting, talking about rate buy downs, points, that sort of thing. Because interest rates are moving higher, people are considering temporary buy downs, considering doing different things. How does this work? What are the questions that should be asked?
So in relation to the rate, the temporary buy down is less important. It's just that's going to dictate what rate gets quoted, who's paying for the buy down on a temporary buy down. When we're talking about a permanent buy down, hey, you told me the 0 point rate is 6.875 for my loan if I lock today. What if I pay a point? Typical rule of thumb is that's going to get you 0.25% lower, but we've had really weird rate sheets the last few years where lenders are incentivizing you to pay those points. So you might get 0.5%. The most important thing in this context is that you're asking the loan officer, what are my options? Cool. This is the 0 point. How much of a credit would I get if I went up 0.25%? How much would it cost me to get it 1.25% lower? It's probably not going to change your mind. You should have had that discussion up front with the loan officer. And again, context of this show being heavily weighted towards first-time buyers, most first-time buyers don't have excess cash. So we're not looking at paying points and buying rates down. That often happens with move-up buyers. Hey, you just sold a house with a 3.25% interest rate. You got $400,000 to play with here, and you're willing to pay a couple points to get something closer to your current interest rate. But what needs to happen is a side-by-side comparison of those options, laying out the cost and the benefit, which is the monthly savings or the cost of it. I quoted a listener here to the show yesterday on a refinance, and she rightly pointed out, I want to see lender credits. And when I looked at it, it was like $17 difference to get $2,800 credit on towards the closing costs. I'm like, that's kind of a no-brainer. Most people say, hey, what would you rather have? $2,800 more cash back at closing with a $17 higher payment, or vice versa? Let's take the $17 higher payment. So it's just important that is being penciled out for you and showing you before you lock, what do those numbers look like?
And Josh, just a quick question. This is something I think a lot of people don't understand. It's not one of our questions to ask, but I'm asking it. What affects the interest rate? Why do some people get a lower interest rate than other interest rates? Than other lenders? What changes it?
Most of you know the biggest factor is your credit score. Someone with an 800 credit score is going to get a much better interest rate than someone with a 620 credit score. In some cases, it's just, hey, I'm not eligible if I don't have X credit score. But in all cases, in generally 20-point increments, the lower you go on the credit score, the higher the interest rate you're going to pay. The longer the lock you need, the higher the interest rate you're going to pay. The higher the loan to value, the greater, the smaller down payment you're putting, the larger or the higher the interest rate is going to be. So those are the big ones: credit score, loan to value, and then that lock term would be the big ones. Property types come into play. If you're buying 2 to 4 units, worse rates than the single family. If you're doing less than 25% down and you're doing a conventional loan, condos will have a higher interest rate than a single family or a PUD or a townhome. So from that perspective, there's a number of factors that go into it. And if you're hearing a rate that is slightly higher than what the market is at, I get this question a lot. So I saw you guys talk about Mortgage News Daily, and I looked it up, and it says 7.17 is the average today, and you're telling me I'm 7.25. And I go, well, you're buying a condo with 3% down, you have a 675 credit score. There's a number of things that go in there. Or for us in Southern California, the thing that's more common, that is the standard balance interest rate. If we're doing a high balance loan with a minimal down, 5-10%, there's an additional 1 point add in fee that people don't want to pay out of pocket. So it's adding 1/4 to 3/8 to that interest rate.
And I'll say something on the flip side, Josh, is that I often talk to borrowers and they say, well, I talked to Josh and his interest rate was 7%, but I looked on my bank's website and they said that I can get 6.5%. And I go, let me see the bank's website that you went to. And then they go there and there's an asterisk beside it. And then you go read the fine print and it talks about buying down points and doing different things in order to get that rate. So, when you see a rate that is significantly better than the rates you're getting quoted, you have to look a little bit deeper, dig a little bit deeper, because typically there's something else going on that your other lender's not offering because it's not something you discuss. So buying down the rate is going to get you a lower rate, but it's going to cost you more money. So understand that, when you're comparing stuff, that you're comparing apples with apples and not apples with grapefruits or whatever fruit that you want to
and
talk
Jeb,
about.
in addition to those points, when you look at that asterisk, it will usually say single family residence, 60% loan to value or less, 800 credit score or higher. So it is literally the absolute best pricing they could offer with a chunk of discount points charged. That's the way most of the online stuff is. The biggest veterans lender in the U.S., they're 100% online. You're going to talk to a kid in a call center. When you look at their interest rate, it says real big what the interest rate is. And you look down real low and it's like 1.47 points. So VA loans are zero down. You know what I've never had someone do, or incredibly rarely have I ever had someone do, say, I'm putting zero down, but I would like to put 1.5% down to buy my rate down. They're just trying to get into the property with as little as possible. But lots of games with the online rate quoting.
All right. So last piece of this puzzle, Josh, is once my rate is locked, is there anything that can change that rate?
Only if something changes in those terms. So all the things that we talked about. So let's say if you come to me and you say, I need to borrow $700,000 to pay off my loan. I'm refinancing. I need a $700,000 refinance just to pay off the underlying loan. My home's worth $1 million. So, okay, it's a 70% loan to value. You're going to be on the lower end of that scale and get really good terms. We lock it, and then we get the appraisal in 7-10 days later, and the appraisal comes in at $900,000. Well, now we're at a higher loan to value. Those loan level price adjustments are going to change. And if we're up over 75%, it's going to change a good bit. So that's the biggest one. Appraisals come in. Very rarely you'll have something where a credit score can change. If someone gets pre-approved and they don't get something under contract for 94 days, well, those things are good for 120 days. So we have to close before we get to 120 days aged on that credit report. Incredibly rare. But if I had someone where we have to pull a new credit report and the score drops 15, 20 points, those things can happen. But if nothing changes in the underlying facts, the lender doesn't just get to call you up and go, hey, we changed our mind. We would like this. You do have a contractual lock. They need to be able to tell you what happened that caused a change in the pricing.
All right, so Josh, going in a little bit, we got the five main questions here, some additional considerations, just kind of a rapid fire. What's the process of locking a rate?
People always ask us, what do I do? Do I need to send you an email? Do I put it in writing? No, you just have to tell me. We have a conversation. Hey, if you want to lock today, 6.8750 points, and we're good for 30 days. So I'm going to lock that. I'll give you a verbal that we're going to lock that. But this is one of the changes. We've gone through the loan estimate before. We've gone through the closing disclosure. Those are new things in the last 10, 15 years that we didn't have prior to that. And prior to that, you often just took your loan officer's word for it and say, yeah, I locked. Loan officer could be completely lying to you. Never locked the loan. And then it comes to closing. Oh yeah, something changed and your rate is worse. Now, to be compliant and have a legal file, which 99.9% of lenders out there want to have so they don't get stuck with an unsellable loan, you're going to get a locked loan estimate. So even if you opened escrow last week and we sent out your initial disclosures and your first loan estimate says we're floating, as soon as you tell me we're locked, within 3 days, you're going to get a locked loan estimate. It's going to say the interest rate, and it's going to say the cost in box A, and it is also going to say how long that rate is good through.
So I was going to tell you when it expires. So
yep.
Does a borrower, following up, you kind of just mentioned it, it's going to show up on the loan estimate, but does someone need a written confirmation? Is that something they should expect to receive once a rate's locked?
The most common thing is the legal requirement. You have to get a locked loan estimate. Many lenders will send a lock-in agreement that just spells it out in writing. Also, you've locked your interest rate. This is the rate. This is the amount of points you're paying, and this is the date that it expires. But they're not required to. They are required to give you the locked loan estimate.
All right, guys. A couple of common mistakes to avoid: just waiting too long in hoping rates that improve.
Hope is not a strategy.
Hope is not a strategy. Not getting lock confirmation, like Josh mentioned, missing lock deadlines. When the rate expires, you're not actually closing on time. It's having to be extended. Those are problems. Making changes that invalidate the lock, like Josh mentioned, assuming verbal rate quotes are guaranteed. Another big problem out there. Josh, you get a lot of calls. I hear you on the phone. Somebody was promised a rate. They call you. My lender didn't get the rate. They changed the rate. It was different than what they told me. Those are problems. Those are mistakes to avoid. Make sure you're working with a professional. If you'd like to work with our team, you can reach us using that link in the description. If you haven't done so already, you like this content, make sure you like and subscribe. Until then, make sure you're buying right, borrowing smart, building wealth. Adios.
Amigos.